started at 7 o'clock. Thank you all. The governor, I think, will be here in about 30 or 40 minutes. I think, Carrie, may I ask you to read the roll call?
Peter Frank.
I'm here.
Secretary Padilla Jackson.
Here.
Linda Eidson. Here. Tim Jennings.
Here.
Harold Lavin. We do expect Harold. Treasurer Eichenberg, have you joined us on the phone? We do expect the treasurer to be calling in. Commissioner Garcia Richard. Here. Lee Rawson.
Present.
Tracy Hartzler. Present. And Mike Messina. We are expecting Mike Messina.
Yeah, we have a
But you do
quorum.
have
We have a quorum. It's a little slim, but we expect Harold by phone or present.
Harold in person,
Oh,
the
there was
treasurer
a-
by
some
phone.
sort of accident down there, sort of TV or something. I don't
Oh,
know.
was there?
I don't know if that's blocking it, and we hope that everyone will join us. Mike is not joining by phone. Okay. And we know Tim is not able.
He is supposed to be joining by phone.
Okay, great. Just want to have a full house. All right. The agenda, are there any comments?
Motion to approve.
Thank you. Thank you. All in favor? Aye. No opposed, so that's approved. In the minutes of the prior meeting, you've all received them and had a chance to read and review, and hopefully if you have comments, provide them by sharing in between meetings, but if you have any comments now, and
Motion to approve.
second. Thanks. All right, all in favor? Aye. Any opposed? Very good, that passes. We'll move right away to Steve's report and then Vince's report. Steve?
Thank you, Peter, and good morning, everybody, and welcome, Tracy. Tracy Hartzler's first meeting with the State Investment Council, and I think we will be thrilled to have Tracy, and she will have tremendous idea of what we're doing, so we're happy to have you with us. And entering at the door is Michael Messina, our other new council member. Welcome, Mike. Happy to have you with us.
Thank you, Steve. Nice to be here.
I think all of you have probably received the CVs for both Tracy and Mike, so we will dispense with asking them to go through their backgrounds for each of us, but I do ask you to take a look at those, and I think you'll be pleased with the skill sets that those bring to us.
And Tracy has confirmed to me that she went through a briefing at the office.
Both Tracy and Mike have been extensively briefed
That's good. Okay.
and given large books to read, and they've done their homework. Thank you.
Very good, very important.
Current net asset value as of last evening was $25.776 billion. West Texas Intermediate as of last evening also was at $53.80. And the 12-month total distributions to the state from the funds through August were $975.055 million. Just to bring you up to date on the data. The tax stabilization reserve, as Brent will tell you, was funded. I'll let him go into the detail on that. We expect some additional inflows. When and how much, we don't know, but we'll certainly let you know. The Rural Library Endowment was established. Brent will bring you up to date on that.
For me,
It was a start. It was $1 million beginning. And hopefully more funds will be coming into that also, if the legislature so wishes,
investment return.
and the governor. Very fine inflows from the state land office. I direct you to the investment holdings report for July 31. The monthly contribution from the state land office, $90.9 million, an increase of $5.5 million from June. Year-to-year comparisons are even more impressive. July 2018 contribution was $72 million. And the July 19 contribution again was 90.3 million. So a jump from 72 to 90, substantial increase. Under investment matters, Vince will cover this for you in depth, but I do direct your attention to the two boxes on my SIO report. In the first box, under total distributions, for the time period July 10 through June 19, $7.9 billion. And if you would look at that in connection with the growth in our net asset value as of that same time period of $12.63 billion, the combined impacts of those two numbers are what the State Investment Council is all about, in my opinion. Among a lot of other things, but this is an important thing. This is what we do for the state. Under council matters, you'll see the September meeting dates for the investment committee and the council. The meeting date for the severance tax investment, New Mexico investment working group of September 23rd, and I mentioned the August 7th meeting there. You'll be seeing the summary notes from that meeting. Committee appointments are something that I suggest that the council may want to consider. Staff has spoken with both Tracy and Mike. We've also spoken with Olivia about their ability to serve on committees and their desire to serve on whichever committee they wish. And this is something the council, I believe, would be well advised to consider. Vince, before I go on with my report, why don't you introduce our newest staff member?
Well, after an extensive and exhaustive national search, we finally filled one of our investment strategist positions. So behind me over here is Mihail Kuznetsov. Mihail comes to us from CalPERS, the big pension fund in California. Prior to that, he had several years at the International Monetary Fund. So great fit for our strategy team, and we're just really pleased to have Mihail with us.
Thank you.
He has found his way to Santa Fe finally after having lived briefly in Bernalillo because of the Indian market. We'll find a place here. We're also still looking for a communications analyst. That's moving a little slower than we had expected. That's a tough one to fill. Charlie's working on that diligently. A New Mexico private equity portfolio manager and a financial analyst. Tu Sanchez was our financial analyst. We have promoted Tu. She is now our financial coordinator, working with Nicole and Brent. She's doing an excellent job for us, and we are now trying to fill her previous position. Brent will go through the FY21 appropriation request with us this morning. I want all of you to be aware that Evan received an appointment from Chief Justice Nakamura. She has established a complex civil litigation task force to try to make that process more efficient in New Mexico. And she's asked Evan to serve with the President of the State Bar and others to find a way to make that happen. So we're proud of Evan for doing that. And I know he's very excited about it. I want to mention to you a recommendation that I am making regarding compensation increases for 4 staff members. It's a total of just $81,000, and that's for all 7. That includes the benefits, the load. The average increase is 8.2%. These are not annually awarded. They're only done periodically. These will bring our staff more in line with both internal and external balance, comp balance, if you will, or pay equity, as I like to refer to it. As all of you know, we're really fortunate to be able to bring in and keep the highly qualified professionals that we have. If any of you would like more information on this, I'd be happy to speak with you after the meeting. Under item E, we met with IPOC on July 29th. I think you have seen that in the weekly. We had a sovereign wealth fund collaboration call. I think all of you know that we convene all the domestic sovereign wealth funds that are able to get on a call with us quarterly. That happened on August 6th. I don't travel much. I really don't travel at all. But I'm going to Juneau, Alaska for 1 day on September 9th to meet with the International Forum of Sovereign Wealth Funds. This is an organization based in the UK that is composed of all the major sovereign wealth funds around the world, with only one member from the US, and that's Alaska. So the CEO of the Alaska Mermaid Fund, Angela Rodell, has asked me to come, which I will. We've also invited all of our other domestic sovereign wealth fund CEOs, CIOs. 5 of them will be coming to the conference, and I will get all 5 of them together on September 9th, and we will meet each other, which we never have, other than by phone. Vince will be unable to go with us because he is putting together a group in Santa Fe. This is the Southwest Institutional Investment Forum, which he has been able to bring to Santa Fe from Scottsdale for the last couple of years. Want to comment on that?
Yeah, so this year, September 12th, and it looks like a pretty good group. We had a little over 100 last year, probably something similar this year. It's been really good for the financial community here, because a lot of these folks can't travel out of state. Most of the conferences are out of state. So when we get something for Santa Fe or Albuquerque, we get good attendance, and the financial pros that come usually appreciate it.
A couple of public speaking engagements during August, which we are always happy to do. Part of my job is educating New Mexicans about the permanent funds, and we seize on every opportunity that is provided to us. Tomorrow I'll be going to Angel Fire with Olivia and others for the LFC Revenue Stabilization Combined Legislative Committee meeting. And Olivia, if you don't mind, would you tell people what's on the agenda tomorrow?
I can't do that, Steve. That's
No, the topic, just the topic.
General fund revenue estimates forecast through FY24. And so the big item being reported is the new money for fiscal year 21. But it's a very comprehensive report on global and national economy, general fund revenue estimates, oil and gas market. But yeah, that's what everybody's there for, is the one number as to what will be available to spend in FY21.
Thank you, that was all I was thinking.
Okay.
Yeah. Mr. Chairman, that's what we're.
Very good, thank you, Steve. Vince?
Thank you, Mr. Chair. I've got a couple of pages of notes here to catch everybody up. Since we last met, the global economies continue to slow a little bit more. It looks like Germany's entered recession or will do so pretty soon. The June GDP numbers were a decline. It looks like the September numbers will also be. That's normally the strongest economy in Europe, but they're heavily exposed to manufacturing and finance, and both of those areas are struggling a little bit right now. Japan is in recession, although that's a sort of in and out, back in and back out for those folks, at least over the last 20 years, maybe 30 years for that economy. The UK looks unlikely to avoid contraction here, probably in the September, maybe December quarter, and probably hit full recession after that. The manufacturing sector globally is in contraction. Most of the PMIs or the measures of manufacturing activity are all below the mark that defines contraction or expansion. And that includes here in the U.S., 2 quarters of decline in manufacturing PMI here in the U.S. It looks like it might be starting to spread to the service sector. We're seeing layoff announcements from some of the big banks and the money managers. That's usually the first place it happens when it starts to spread to the service sector. And likely then the areas of the economy that could be next would be the ones that require debt to operate. So housing, construction, autos, banking, those sectors would, if this continues to spread, those would be the next ones where the numbers will start to fall. So we're keeping our eye on that. One of the big topics that's been talked about extensively are the negative interest rates around the globe. There's about between 16 and 17 trillion dollars worth of primarily government debt. There's a little bit of corporate debt in there, and just a little bit of mortgages. There's actually a Danish bank issuing mortgages at negative interest rates. But there's between 16 and 17 trillion, which Matthias pointed out at the CIC meeting. That's about 25% of the global government bond market has negative yields. Now, if that question were on a test in one of my economics classes 30 years ago, I would have missed it because negative rates aren't supposed to happen. So anyways, we're really keeping our eye on it. We've seen rates here in the U.S. drop precipitously. We've seen the 10-year went from about a little over 3% down to 153. What's it at today, Clark?
That's about right.
Yeah, about 1.53%. We think it's just the gravitational pull of negative rates overseas. And bond investors overseas are being forced out of those bonds that come here to the United States to buy U.S. bonds, really pushing our interest rates down. Bart and I just started to talk about it, but PIMCO suggested perhaps negative rates could find a home here in the U.S. And so we're just now starting to talk about what in the world would we do if we saw our own government bond curve go under zero. The big Norway fund has about 25% of its assets in negative yielding debt right now. And we just started to talk, but if you plug a -1 as your expected rate of return for your core bonds portfolio into your asset optimizer, it's still going to allocate to those bonds. It's just a lower rate of return. So we need to think through what the process will be. If that were to occur, that would be pretty serious. So, I think, up to, right now we're at a quarter of the global bond market at negative rates, and we haven't seen any big disaster yet. But if negative rates come to the biggest and most liquid bond market in the world, which is ours, that's a different story. So keeping our eye on that story, that one's important. We're also seeing yield curves in many or even most countries that issue government debt in their own home currency are very flat or inverted. That's unusual. Normally we have shorter rates or lower than higher rates. But right now rates are just about the same across most yield curves, and it's even inverted where long rates are lower than shorter rates. That happened here in our bond market. The 10-year rate dropped under the 2-year rate. That's a typical comparison that people make. And the 10-year has been below the 3-month rate for quite some time now. So we've had an inverted yield curve here in the U.S. The second big topic really is the trade war. That continues, but it also continues as a day-to-day thing. We kind of watch the news every day on what's happening with trade wars. Is it bad or is it good? The market's been responding in that same manner. Mnuchin was just out this morning saying we may be closer to a deal. That's got stocks a little higher and moves a little bit better. I think the biggest impact of the trade war is not so much obviously on trade, reduction of trade flows and increased costs. But what's really hitting the economies due to the trade war is the reduction of CapEx expenditures and plans by companies. So companies are holding back. They're not making that, at the margin, they're not making that investment or hiring more people and that kind of, because they're uncertain about what's going to happen in the long run with global trade. That's probably having a bigger effect GDP-wise globally than the actual trade war itself. Consumer still seems to be in decent shape. Like I said, if these lower economic conditions continue, you'll probably start hitting some of the big ticket consumer items, but Target reported their quarterly earnings and just blew it out. I mean, both on revenue and earnings. So people are still out spending money on day-to-day household things. For now, they have cash income to do so, so we're keeping our eye on them. Last, I think on the economy, the Fed's vowed to keep this expansion going. They don't have a lot of firepower, just about 2 percentage points on the Fed funds rate, and they're still $3.5 trillion on the balance sheet. So who knows if they go back to any significant quantitative easing with that size of the balance sheet to start with. In the markets, of course, volatility. If we look back at the last, not the last peak, but the peak that occurred in January of 2018. So that was at the tail end of that 23 or 24% run in the stock market. From that point to yesterday, U.S. stocks have compounded at only 3.3%. You know, 2% of that was dividend yield, which leaves about 1.3% in price appreciation. There was 2% inflation over that time frame. So we actually had a negative change in real stock prices over that time frame. Bond market, of course, has been a way different story. That's compounded at almost 10% for that 19-month period, mainly due to interest rates really falling, and we think that's a lot of foreign demand for U.S. bonds due to negative interest rates overseas. If you include, well, the foreign stocks have been just awful. If you include them in with the U.S. and take a view of global stocks have compounded at a negative 4.7% over the 19 months. So rough time, again, the volatility on the markets have been about double of this 19-month period over what it was the previous 2 years. So lots of volatility, sort of lower rates of return. Now, the themes that encompass these specifics that I gave you, you've seen it before. They're in the 2017, 18, and 19 annual investment plan. So heightened volatility, lower rates of return. We didn't quite see the move in the bond market. That's not in there. But a lot of things we've just been talking about, weaker growth, late cycle, potential for recession, all of those things, you've seen those in the annual investment plan. So this group around this table has already talked through these things. We already laid plans, we've already taken action. So we cut your equity weights, publicly traded, we moved that capital to income-producing assets, primarily in the real estate, real return area. We did a liquidity plan and structured raised liquidity for this portion of the cycle. So we've been ready and to deal with this environment that we're in for now. I think, again, you'll see that I think it's paid off. You saw some of the numbers on the from Steve's presentation, and Marshall and Matthias are going to go through the more specifics on our June numbers. But your 3 main policy goals are to make 7% in the long run, to beat benchmarks, and to control volatility. These guys are going to show you that we've done that. I think it's due in part to the advanced planning and things that we've sat around this table and talked about and positioned the portfolio. So with that, Mr. Chair, I'll take any questions or pass the motion.
So I have a question, and I know you said you were just starting to think about negative interest rate environment. What are the options other than a mattress, a currency in a mattress like this? We had that a pretty big mattress for our currency.
The first thing I did, Peter, was start looking for other institutions like us, and already hit the screen right away. I mean, they're way bigger, but they just accepted it. I don't know how willing I am to do that, but that was their. Now, I haven't talked to anybody over there. It's just observation. Right. That their weights in bonds has not changed in the last 2 years. They will have a few percentage points, but their allocation has not really changed in the last few years as interest rates went from positive to negative.
Mr. Chairman,
Yes.
I just recently visited the Supreme Court and learned that they have the old vaults.
Oh,
It
good.
used to be in the Senator's office, and so maybe Tim can let us use that.
Just do a pile of currency up there. Make a lot more money than paying negative interest rates.
I guess on the positive side, even if we have to accept negative rates, which I think probabilities are still relatively low, we'll see how things develop. is, you know, we entered late cycle, our indicators told us the second quarter of 2018. And when we do that, we always say, okay, we think the highest probability for recession is, so just so we can plan on a certain. And so we've picked the second quarter of next year, and we've talked about that a lot in here. If that pans out and we get markets lower, we can spend those bonds on cheaper stocks,
Cheaper
real
stocks,
estate,
right.
things like that.
Currency. Anyway, any other questions or comments? Thank you very much, Vince. Vince and Marcia and Matthias.
Well, Matthias
We
is going
perform.
to take us through total fund, but I thought since we were talking about, Vince gave us an overview of what's going on, we should maybe step back and go to page 17 of your report, since we're going to be talking about June and look at June. Just also want to point out, not to add to Vince's commentary, but something that Vince didn't talk about is also the growing debt. And we can see at the top here that, you know, obviously we're in the highest quartile for debt, and it continues to grow, and that's making headlines more now than it was. But stepping back to June, if you look for the quarter down at the bottom left-hand side, you can see that risk assets did do well for the second calendar quarter, your fourth fiscal quarter. But the only negative index we're showing here is commodities. If you go over to the one-year number, you can see the effects again in fourth quarter of 2018, where there's actually negative returns, annual returns for small cap stocks and for both internationally and in the U.S. And then again, commodities negative for the one-year number. Also looking over at the yield curve at the end of June, you can see that the yield curve dropped pretty significantly with the interest rates falling. You see that the Bloomberg, as Vince mentioned, that the ag had a terrific month or quarter of 3.08 and up 7.87 for the year ended June 30th. It's not only a surprise, pretty much a surprise to everybody, seeing those strong bond market returns. If you bump ahead to page 20, you can see the allocations. The variances are shown below the actual tables, but you can see some no's there. Remember, you approved the interim allocation that was effective June 1, so you can see that you're not at some of those interim targets with slight overweights to your 20%. Your interim target to equities is now at the long-term target at 20%, both for the U.S. and non-U.S. And at the end of June, you were slightly over that. Also developing your non-core allocation, you were underweight there. So some slight underweight, certainly within your policy target ranges, but impacted by the move to interim targets effective June 1. Matthias is going to take us through total fund, and then we'll talk a little bit about the asset classes, at least your public asset classes, because you're going to get big reports on the private assets today.
Excellent. If I may turn your attention to page 24, we'll start there. This is the investment policy review. Here, this is a page that we look at on a quarterly basis to evaluate really how the funds are doing relative to the objectives we set forth in the investment policy document. And this is a document that we'll be reviewing later this year for you as well. And as you can see on the top half of this page, both for land grant and severance, both funds are meeting their return objective. Now, not only are they outperforming their respective benchmarks, but they're also exceeding, at least over the longer time period, the expected return of 7% and 6 3/4. So this has been a fairly strong market environment, but we are expecting, and as you look at the more near-term numbers, we're expecting some weaker growth and lower returns going forward, and I think that has been fairly well telegraphed. So we're encouraged that the objectives are being met, and if you slide down to the bottom table with all the numbers, you can see that particularly for the longer time periods, we have very strong and consistent returns both on an absolute and relative basis relative to the benchmark. So These are annualized numbers, so for the 7 and 10 years, you can see that you managed to earn 8.5% and 9.5% respectively. And then as you slide to the left-hand side, the more near-term numbers, you see those returns being somewhat lower. Now, this has been an environment that has been quite unique. Many of us really haven't seen that. We're so late cycle, and despite that, the Fed and others are really trying to instill as much momentum into this market as possible, despite being one of the longest economic expansions in history. And so this is interesting. We've had the negative rate scenario as well, which has pushed fixed income markets to new heights, and we've seen that. So really the two best places, even though they're arguably also the most expensive places, are large cap U.S. equity and fixed income. So it's a bit of an interesting scenario, but quite frankly, I'm much more comforted in the way that you've positioned, taking chips off the table, than perhaps trying to time it down to the right day, because as Vince mentioned, it's different every single day if you turn on the news. On page 25, this is the attribution page that really provides a scorecard in terms of how the return is earned, what's been working, and what hasn't been as successful. This is over just a quarter. We have longer time periods in the back, and as always, we tend to encourage you to look at longer time periods. But here we're just looking at the quarters, so you can get a snapshot of that experience. And you'll notice that I'll try to provide a little bit more detail, because I know we have a few newer members that haven't seen this page, and it's not terribly intuitive or self-explanatory, I think, the first time through. So at the top part, you'll see the various components of the return experience, and then the bottom half breaks each of those components down, and I'll walk you through that. So you can see that the Lang grant, the investment pool performance, returned 2.7%. The actual strategic asset allocation, so the policy allocation that this council sets, would have actually returned 2.87. Now, not all of that is investable, so it's not quite apples to apples. But regardless, you can see there was a bit of underperformance for that quarter, despite being reasonable returns. And so where did that come from? And those are the yellow, orange, and purple boxes. So the yellow is tactical, although that's a bit of a misnomer, because there's really not too much tactical movement going on, but it's really just a byproduct of not being identically allocated to your target allocation. Sometimes that's intentional, but oftentimes that's just a byproduct of managing the portfolio. In that case, it helped. Style selection, so when you take a differentiated implementation approach to an asset class, it can either work for you or against you. In this case, it was a modest addition to the portfolio. And then the manager skills, so the managers relative to their individual benchmarks on a strategy level, that can work for you and against you. And it's been reasonably successful for the long term, but again, in a short time period, it may or may not work. So it's not the best time frame to look at this. But you can see overall, relatively flat with some exceptions. Private equity in particular is the one that's furthest to the left. And then you have a little bit within U.S. equity, which tends to have more of a defensive positioning in this particular portfolio, as well as non-core fixed income. So that's how that chart comes to be, and I'm sure we'll discuss that in future meetings as well. The same is true for severance on the next page, page 26, except you'll see that the one difference being that the purple bar is larger, and there you have some differences within private equity, given that has some exposure to the in-state New Mexico private equity program as well, which lagged the national program. Page 28, just a reminder that it's in here. We have it on the prior page for the calendar year, but here we'll look at the fiscal year since we're at the fiscal year end. You can see a scorecard essentially of all the funds, so the total fund aggregate at the top with the beginning market value, the cash flows that happen and these are netted out, so they're either net positive or net negative. Gain loss, you can see over that 1 year period, all the funds in aggregate added 1.4 billion, so quite substantial, and we're well over 25 billion now in aggregate. And then the return on the far right-hand side, land grant, severance, tobacco, water, and then the external client pool are all listed here as well. And just a couple observations that I think are probably noteworthy is that severance tax from a cash flow perspective remains a little bit challenged. But fortunately, we have a strong enough market and then strong enough performance on the gain side to offset those negative cash flows. And then on the external client front, that's been quite successful as well. Cash flows and return experience are quite positive. So if we turn to page 30, we'll start taking a look at the actual relative returns, and this is really from a peer perspective to help identify how the funds have done relative to other funds that are of similar size and in some cases of similar objectives. And as I already mentioned, the funds that have done the best over the near term are the ones that have the most U.S. equity and fixed income, the two things that are arguably the most expensive and things that we've been trying to sell on the way, essentially on the way up, not on the way down. And that's been quite good, but this market over the short period has rewarded those that are very concentrated in their investment strategy and not well diversified. We did look at those funds over different time periods, both over the long term as well as market drawdowns like we saw in the fourth quarter of 2018, and those were not the best performers at all. So it is comforting to see that those are not plans that are well positioned for market dislocations or for long-term strong results. So on page 30, you can see the various time periods, and this is a change. This is a change to what we've historically been able to show. So historically, we've been able to show the peer group data gross of fees. We're transitioning to net of fees. Arguably, that's what you're actually earning after fees are paid. And you've had a bit of a handicap because relative to other institutions, you have more assets that are reported net of fees. So you've essentially been, in some ways, reporting a net number into the gross universe. So it was a little bit of a handicap. This is a much better comparison, really, by most measures. And so we're encouraged to that, and I think this is a peer group that will continue to get built out, more population and broader participation.
That's really what Vince has been talking about for quite some time, so we're glad.
Yeah, we probably don't have to look at tucks and all these, because I think it was probably somewhat confusing to have all these different peer groups. Hopefully, having a single peer group to just look at will be more helpful. Now, the gross numbers are in the back. They're just as good, and that's actually even a little bit better, but they're in the back in case you're curious. So we didn't take anything away from you. We just wanted to focus you on what we think is the best measure. So here, you'll notice, and I'll probably drop you to that bottom bolded line that says all public plans greater than $1 billion. When you look at the actual composition of those plans, it's most similar in terms of size and resources to yours, and so we think that's likely the best measure. You can see that for the quarter to date, 71st percentile, so that's what I mentioned, a little bit of relative underperformance given those plans that may have more publicly traded equities or fixed income. But then you start taking into the fiscal year to date, where you actually have the fourth quarter and a full up and down market. There you're 36th. You drop to the 3-year, you're 30th, 5th, 5 years 29, 7 is 32, and 10 years 25th. So you're essentially in the top third out of all those longer trading time periods, which is pretty incredible, and hopefully something you all are proud of. The next page, page 31, this is the one that I know we always like, and it's one I think that is testament to the tremendous consistency that you've had in your results, and a stark contrast to the history. So where before you could see you're either at the top or the bottom and whipsawed essentially by what the equity markets are doing, you've managed for essentially the last 6 years or so, a little longer than that, to just stay right within a fairly tight range, despite what the market has done of being above median. And that's what's allowed your long-term ranks to continue to improve. So if you look at those really over time, they've continued to ratchet up, and you don't have to be first every time to get long-term good results. You just have to do above average in any environment, and you'll automatically rise to the top. And so that's exactly coming true. Page 32, that's for severance. Very similar inferences, conclusions, and takeaways, with the exception being that the private equity return experience is a little bit lower for the reasons I already mentioned, so the ranks are just modestly lower. On page 33, you can see the allocations relative to, at the top, relative to your peers, and no surprise there, you're going to have a little bit more in some of the alternative asset classes, in particular real estate, and a little bit less in U.S. equity. So all of that is by design. I think the last thing I'll mention before Marshall will just give you a quick rundown on the individual asset classes and their relative success is page 34. I think this is quite telling. It's showing you your risk and return. It's somewhat I think singular to just look at return without giving any acknowledgement to the amount of risk that was taken on in order to achieve those returns. So this page does a nice job trying to highlight what amount of risk was taken on to achieve those returns. And so here you can see over that 5-year period, I'm looking at the top left-hand box. You can see over the 5-year period, the land-grant return, a little over 6%. That compares to the median plan of about 5.5, 5.6. So you've returned 109% of the investment return for the median plan, but done so with only taking on 89% of the risk. So more return, but taking on substantially less risk to do that. Over the 10-year period, it's not quite as good, and again, the strategy I think has continued to improve over that time, but even now the 10-year number is 105% of the return with 100% of the risk. So that's the bottom left box there. When you look to the two boxes on the right-hand side, that's looking at all public plans. So those are plans that tend to be a lot smaller that are included in there. And the smaller plans, because they don't have the access and the scale to diversify into private equity, rural return, some of these other things that you have, tend to just by the nature of their size have more equities and more fixed income, primarily more publicly traded equities. And so because of that, if you look at the risk, so the standard deviation median on the top right-hand side, it's 6.97. Versus on the left-hand side, 5.94. So those plans tend to be quite a bit more risky. And so when you compare yourself to that, you've captured 103% of the return, but have done so with only 76% of the risk. So the amount of downside protection and ability to generate return with substantially less risk, I think, is something that shouldn't go unnoticed.
I like these charts a lot, Matthias has put these together for us for a number of years. One thing to notice on here that every time that chart pops up, the first thing that pops into my brain is, look at the dots on any of those 4 charts. They're not necessarily upward sloping. So risk isn't getting paid. In the last 5 and 10-year periods, you could have taken on the upper right-hand chart, you could have been at 4.92 vol, and earn the same amount as somebody at an 820 ball, right? So risk is not going to be getting paid in this market. That tells you you want to be on the left-hand side of that chart. That's where to position yourself when risk is not getting paid. Now, if we get a big downdraft in the stock market and we get better expected future rates of return, we might want to move out to the right-hand side, or at least closer to the middle when risk is getting paid. But right now, those charts are telling us now's not the time to be jumping out there.
Good insight.
If you look at that chart, the risk return charts, and the 3-year rolling ranks, I mean, those are
Very strong.
very strong. Just a couple comments on asset class. So we're not going to, we'll just look at the public market asset class because we have reports today on the private. So there's a summary on page 36, but just quickly we'll go to 38 and look at the your U.S. equity structure update and then the composite. This is just a reminder of moves that you've made. Sizer was terminated and effective at the April SIC meeting. You also, as I mentioned earlier, moved your interim target to your long-term target for U.S. equity, so that's at 20%. There has been some news out of JP Morgan, but nothing, not bad news, nothing that gives us pause. So we'd like to give you just an update with what's going on with your manager. But if you go to page 39, the top part looks at what you state in your policy for your objectives for your U.S. equity portfolio, and you can see that for the return beating its benchmark, that you did not meet that objective over that period, but you did meet it when we compare you to other U.S. equity composites. So what does that tell you? It tells you that it's been a very difficult time for U.S. equity portfolios to beat a passive benchmark. As with the portfolio, you have positioned your equity portfolio to be a bit more defensive than many of your peers. So you haven't beat that Russell 3000, but I think it's very telling to look at that you're in the top third compared to your peers. This page shows below both your gross and net of returns, shows the performance of your large cap and your mid cap. Really no more comments there, just an understanding that you have. It's been on purpose that you position this portfolio in a little bit more conservative manner. And that's reflected on page 4 when we look at the risk return. This is for a 3-year period. I think we can probably lengthen those time frames, but you can see you're at median return, that you have less volatility than many of those dots out there. And looking at the right-hand side, I think it's also telling that over this 3-year period, when the market was going up, you didn't capture as much of that. When the market was going down, you protected. There's only been 2 quarters that the market's going down, so having a more defensive portfolio hasn't been that tailwind that you expect it to be over the long term. Yet. And we saw that reflected, into the fourth quarter, right, of 2018. So I think that's very.
So Vince, did you have some further comments you wanted to make, or?
Liquidity.
Oh, right, yeah. I forgot on my previous briefing. Steve wanted me to give you a report on our liquidity position. You've been reading more about it in the news, I think, we're talking about. We've got between $600 and $700 million in cash. That's about 2.5%. That's divided between balance sheet cash on land and Severance's balance sheets and cash in the private pools to meet capital calls. That's a little high for us. I normally manage that down to about 1%. The markets are just getting volatile. We let it creep up thanks to Stephanie's contributions to the fund a lot. That's really brought a lot of cash in. So about 2.5% cash. We've got about $3.6 billion in the core fixed income portfolio. It's a little over 15%. All of that, all of those securities, most of those securities in that portfolio, if we got into a stressed risk environment, would go up in value, and there would be a long line standing around with buy from us. So that's money good in a risky market. And then we've got another $300 to $400 million in other liquid assets, non-core fixed. We've got some in the real return portfolio that would also be liquid and available for us. So all total, our total firepower is about 19.3% of the portfolio, ready to go if we get an opportunity.
You said $600 or $700 million in cash. Where is that cash?
JP Morgan sweeps.
And again, what are we getting?
Nothing.
So it's an expensive hedge, but maybe important for the rest. I hope so.
To some degree, we've got to keep amounts in the private pools to meet the capital calls.
Right.
I've looked into ways to try to securitize that.
Yes.
It's difficult because we price just monthly. I've got a scheme I'm talking to Brent about. We haven't come to a conclusion on it, but
There are no auction rate securities.
well, we're looking for a way to sweep that cash, to have that cash swept out of those pools into a separate pool where I could securitize it, but be able to move it into those pools when it's necessary, intra-month. But the accounting for it is difficult, so we're working through that.
Well, the accounting for it is difficult.
Yeah, we're not sure we can do it.
Yes.
Mr. Chairman, I was just curious, you said for opportunity that may come up with interest rates going down, what types of opportunities do you have in mind?
Well, if we had a sell-off in risk assets, primarily stocks, and we could forecast future rates of return we're much better than we're forecasting now. We could deploy that, portions of that or all of it into risk management.
I guess I'm still tripping. You don't mean mechanically accounting, you're not talking about something that Brent can't solve. You're talking about our ability to move money between pools or
Intramonth.
intermonth. Got it. Okay. Lee, please.
Vince, what's the current rate on our sweep?
Pretty much zero.
Zero.
No, that's not true. We're probably 1.5, 1.75. It's under Fed fund. Because we have the safest, most secure thing.
Okay. July, we don't have anything.
Oh, performance numbers?
Performance, yes.
I think I've got the JP Morgan first cut, but RBK is still crunching those numbers.
And I want to point out that we look on page 39 under explanation, it just doesn't reiterate what the returns were. We've actually put an explanation of returns in there at your request.
Okay. Very good. All right. Real estate will return all.
Good morning. So, I'm Paul Chapman, Director of Real Estate and Real Return, for those that haven't met me before. And Seth Marcus, Townsend is our real estate and most of our real asset consulting services. So Seth is here to report on the quarter performance. This is Q1 of 2019. Generally, things are going quite well in both our real estate and real return portfolios, real asset portfolios. Real estate is generating about a 3.5% cash yield now. That's down somewhat from prior years when rents were growing much more rapidly. The real asset portfolio is a little bit less than that, around 2.5% cash return. And of course, the rest of the return that we expect comes from appreciation and value creation. So with that, I'll just turn it over to Seth.
Thanks, Paul. Good to see everybody after a July off evening. So again, I will talk here about the first quarter performance. When we were here in June, we talked about year-end numbers. We talked a lot about sort of performance there. We had in-depth, detailed analysis on each of the investments at that time. So I'll be a little bit more brief here, but happy to answer any questions throughout the presentation. You may also notice we did reorganize the slides a little bit. We really only talk about 3 or 4 slides in our presentation. There's a lot more information in here, so we moved the more qualitative slides down in the presentation, so just to highlight that change. But everything is in here, nothing was removed from the report, just for your knowledge. So example, on slide 4 now is the total real estate performance, time-weighted returns as well as IRRs. And you'll see there, and we'll just take 30 seconds to explain why there's 3 bars there. Numbers. The first bar is the total real estate portfolio performance, the 1.4% for the quarter, the 6.5% for the 1-year period. The middle bar is the new commitments made since 2011. So there's a significant restart, I'd say, of the portfolio. So these are investments made since 2011. Since that time period, the council has made over $2 billion in commitments over those 8 years across 35 different funds. So that's across core and non-core investments. And that is really what's driving the performance today. That portion of the portfolio is about 97% of your real estate net asset value today. It's really driving that performance. You'll see the 20 to 30 basis points of outperformance over the quarter, and over the 1-year period, the total portfolio matches and the rebalanced portfolio outperforms by about 40 basis points. Longer term performance consistently outperforming with strong IRRs out of both portfolios. Quarterly performance does remain volatile. We do see valuation adjustments, specifically in the second quarter. We'll talk about that in a month or to within the retail sector, as well as currency fluctuations and also debt mark-to-market as interest rates adjust. Despite a number of quarters where we did show underperformance over the last year, we do show matched performance over the one-year period at 6.5%. Again, beyond the one-year period, you see significant performance. I'll jump ahead to slide 5, and I know there's different page numbers, so I'm referring to the slide numbers in the bottom right-hand pages of my presentation. So from an allocation and capital commitment perspective on slide 5, 2019 looks to be one of our more active years, and that's not a surprise given some of the core commitments made, but as you'll see there, the non-core, the dark blue bars at the bottom, are pretty consistent over the last 7 years. We made about $250, $260 million in commitments in 2019. We are looking at making that similar size commitment going forward. This is based off Townsend's investment casing plan to basically maintain our allocations of sectors and also grow our total exposure of the fund to real estate. The reason for the maybe outsized commitments in 2019 is that light blue bar of core commitments. So you'll see there $300 million single commitment to one fund. That was a rebalancing of the equity portfolio. We've talked about that in prior quarters, but that highlights that number. Additionally, we'll be discussing shortly an additional $125 million commitment to another core fund. This is part of the rebalance of the available cash from the tax stabilization fund. So this is capital not planned for at the beginning of the year, but because of that tax stabilization capital, we were able to make another, or potentially make a new commitment again to core. Well, we are also looking at another core commitment this year. What's not highlighted in this chart is that we have made a number of redemptions. So historically, we have not made any redemptions up until 2018. Earlier this year, you may recall we redeemed from the Berkshire Multifamily Fund.
From what? Berkshire?
Berkshire Multifamily Income Fund. And recently executed a partial redemption from the UBS Fund. Both of those, just actively managing the core portfolio, those are open-ended funds. We anticipate that capital will come back over time, so not immediately, we're not going to see that money immediately, but we are rebalancing the portfolio, making commitments alongside those redemptions. So not highlighted here as redemption, so slightly missing some of the reason here. Lastly, the other primary slide we typically talk about is slide 6. And this one takes a little bit of explanation, but here we are showing fee savings of about $2.4 million on an annual basis, of year in and year out. Now, the SIC, because of its size, because of the commitments it makes, is able to negotiate reduced fees versus smaller investors and funds. However, on top of those reduced fees, through the Townsend relationship, we are able to further negotiate because of our position in the industry, additional savings to you all, to your bottom line. So that is $2.4 million of savings there. Importantly, this is no way any benefiting, this does not benefit Townsend in any way. Our fees, our revenues are driven 100% from clients like yourselves and other investors, not from the investment managers. And then the last point I did want to make this quarter is the 9.4% of total plan assets is a slight reduction. So the real estate portfolio today represents about 9.4% of your total plan versus a 12% target. That's a slight reduction from year-end 2018. It's really a factor of the denominator effect, so equity is rebounded after a weak December. But the real estate portfolio on its own did increase by about $79 million. That's net of distributions, net of fees. That was an increase from both appreciation income and capital being invested in the market. So that portfolio is growing. We anticipate in the second quarter that number to significantly increase from a total, from an allocation perspective, closer to 10%, and nearing the 12% target range. That is due to that $300 million core commitment that was fully funded in June. So that will jump up, increase our real estate allocation.
Just for the benefit of the new members, since you mentioned fees, I want to remind people that Townsend's on a fixed fee.
Correct.
There's no performance element in the Townsend fee or the RBK fee. Or a pavilion fee, which is, I think, very positive for us.
And the last point I'll make is we are sitting here at the end of August, is the second quarter numbers have started to come in. We are seeing, as I mentioned earlier in my comments, some reduced returns due to some mark-to-market retail assets being impacted by the global change in consumer consumption. So about a 1% return for the index was what the VMX reported in the second quarter. As I mentioned, the rebalancing out of some of these funds is a result of how we feel about some of the mall exposure. And for that reason, we're also talking about Clarion later on today, who has zero mall exposure. So we're looking to actively manage to take advantage and reposition the portfolio. With that said, there's, like I said, a number of additional slides in here, and happy to address any questions or anyone.
Yeah, I think our approach generally, again, maybe I'm repeating stuff for the benefit of new members, is we obviously provide you the material almost a week ahead. A week ahead, and so you have an opportunity to read through all of the material. We don't really want to take a lot of time at this table to go through each chart and each analysis, but we really do welcome questions or clarification. Some of the stuff is a bit obscure, particularly if you're not full-time in the real estate investment market. So if you certainly ask any question, nothing is a split question, but we move fairly rapidly through these performance reports. Our job is to assure that this reporting is made, and on the top down it looks decent. Our expectation is that Vince and his team review these reports in minute detail and make decisions based on them.
Mr. Chairman, I would
Yes.
also add that, attending the investment committee meetings,
Yes.
even if you're not a member, you have access to staff and sort of just a little bit more space to.
I would encourage, I know Michael and Tracy, I don't know what your time commitments are. I know this is probably, I'm sorry, Michael attended? Good. Everybody's invited to attend Linda's committee.
Absolutely.
She's very enthusiastic. And, I know Lee has attended normally, very continuously. So that's a good place to get into more detail, because the approach is to vet these investments in somewhat greater detail at that level, bring their recommendation to us. Of course, we will ask questions, we can deliver a great recommendation. And our focus is policy, adherence to policy, and procedure, as opposed to backstopping or second guessing Vince and his team on individual retail investments. Okay. Yes, Tim, sorry.
I just, when you start looking about real estate, I mean, there's been all the difference between the millenniums coming up and the past generation is all the stuff when you look at all their multifamily housing and stuff, is all that stuff, is it factored in right away? I mean, kids now, people don't buy ranches. I mean, it's all the old generations that bought that stuff. People don't buy big houses. People don't buy big cars. And, everything is just downsizing. And how much, is there any way to know how much that effect is having in the marketplace?
I think, what's happened is people are forming households at a later age, where, in my generation, we were kind of out of the nest at 22 or something like that. Now it's more like average time you set average time you set up your own residence is sort of in the late 20s now. But that's been an evolution, so it's all been baked into the numbers. But what we do track very carefully is the size of the age cohort that's moving into that multifamily renter space, because we invest a lot in multifamily. So we and our managers are very aware of how many people are moving in, that next generation, the people that are 18 now, that are moving through college, and what's that going to do to future demand for multifamily. The other thing we track is, there's a lot of renters by choice at the 55 empty nester kind of age cohort. And that's driving a lot of demand, both in urban areas where we see a lot of millennials, but also in sort of suburban areas as well. So it is all baked in, and but it's a super important aspect of how the whole multifamily space plays out.
It just seems like there's so many, at least in our bank, some of the stuff we invest, we get so many housing developments where they go in and tear the old place down, and it's all downtown, and it's all stuck right there together, and you're just piling people together in smaller and smaller spaces, and more like China. You know, I mean, it just seemed like the whole family unit is almost getting closer and closer together.
Yeah, well, and multifamily units, if you go tour multifamily properties now, the average size is getting smaller and smaller and smaller. It's just, you know, you got kids moving into these studio apartments that are, you know, 100, 400 square feet. And, you know, the old two-bedroom that used to be 1,100 square feet is now 850 or something like that. So there is a lot of shrinking of the average unit size. And then they move the amenities outside of the unit, you know, into more of the public areas, the rooftop decks and the you know, game rooms and things like that.
But they're paying for it. I mean,
That's what we hope. That is our hope.
So real return?
Sure.
Return to that.
So we'll jump to real return, and this is a new presentation, or the second presentation in the Townsend materials. So again, here I'm starting at fresh page numbers on slide 4, but moving into, so real return has a target allocation also of 12%. That includes both real assets as well as financial assets. Historically, in this report, only the real assets component is reported, so that includes about 80% of that 12% allocation, so roughly 9.5%. However, starting into, so this includes infrastructure, timber, agriculture, and timber, or an energy. And going forward, we've talked with staff and we've been able to include the financial asset portion within this portfolio. So going forward in the second quarter, you'll see a lot of numbers change because we will be including those financial assets. You've gotten it in your other reports, RDK reports it, and this way the full 12% allocation will be captured in this report starting in the second quarter. So the new financial assets that will be included are both MLPs, and then we made two commitments to real estate debt earlier this year and at the end of 2018. So those will be included, and we'll be working towards that full 12% allocation in one report, a lot cleaner. You will see more volatility because of that MLP portfolio, but we'll still break it up and show you the real assets versus the financial assets performance in the next quarter. So just a heads up going forward. As stated in the presentation, there's a lot of text here. There's a lot of qualitative information, unfortunately. But if we look at slide 5, the portfolio is now approximately 8 years old, started in 2011 with a single investment to energy, $50 million, and now consists of a market value of approximately $1.6 billion across those 4 sectors I mentioned, so infrastructure, energy, timber, and agriculture. This $1.6 billion is spread across 34 different fund positions, with only 18 different managers. So that was part of the initial strategic plan of this portfolio, to establish relationships with strong managers and commit to follow-on funds that can invest across these asset classes. This includes a $100 million follow-on commitment made in the first quarter to BlackRock Energy and Power Infrastructure. This is a combination of infra and energy to an existing manager. The historical commitments on slide 5 highlight the $200 million in commitments made this year. You'll see it's slightly lower than we have committed in prior years. That number's going to increase. We are talking about an additional infrastructure commitment with staff today. There's an additional energy commitment that I know Mercer and staff is looking at for later on this year. So that number will likely increase into the $300 million range, consistent with the past 3 years. On a funded versus unfunded basis, the portfolio represents about 6.8% of the total planned market value versus the 12, or about the 9.5% target, sorry. So when you include unfunded commitments, we're at about 9.5%. So we're there on an unfunded plus market value commitment level, but we need to be there on a fully funded level, so that's why there's additional commitments to be made.
We would not expect a lot of distributions out of this portfolio.
Not at this time. You are receiving some income distributions, about 2.5% on income.
Yeah.
There are some short-term holds that have generated some strong returns. You are getting some distributions from that, but mainly this is a cash outflowing portfolio.
With that commitment level, we hitting that target in the next few years, I presume.
So from our pacing models, it's still about 3 years out, because capital will be starting to come back. from some of the initial commitments made in 2011 through 13. But a lot of this capital within this portfolio is also invested in open-ended funds, where that capital is out there perpetually until we want to rebalance appropriately.
The cash generator in this real asset portfolio is really the well, we get dividends from the MLP portfolio, which are not reported in that 2.5% cash return number, but it's the infrastructure portfolio that really drives cash flow.
Yes.
Mr. Chair, would you be able to speak a little bit, either staff or Paul, or maybe staff, on the energy investments and kind of what are our approaches to looking at fossil fuel versus renewable energies as we kind of move forward in increasing our energy investments?
So we see a lot of renewable energy investments. I mean, it's a huge investment space now, and I've forgotten the stat, Clay, you may remember, but of all the new energy generation that's been put into place in the U.S. in the last year or 2 years, it's like 2/3 or 3/4 is coming from renewables. So we get that in our infrastructure portfolio and in our energy portfolios. So we spend a lot of time, and our managers spend a lot of time looking at both solar and wind energy here and globally. But you know, we're also a big investor in fossil fuels, and you know, a lot of that benefits the state, but there's a lot of activities, you know, in Texas as well. So that activity is sort of broken up between upstream that we do some of, but it's not a huge amount of portfolio. But there's a lot of pipelines in our various portfolios, in the MLP portfolio, but also in the infrastructure and energy portfolios. So we do play in both spaces pretty aggressively, but very much so we're active in renewables.
Thank you.
Maybe just one other quick comment, and then I can open up to any other questions. The slides 6 and 7 both touch on the performance of this portfolio. Now, this is a relatively, 2011 sounds like a long time ago, but when you think about these strategies of these portfolios are 10, 15-year funds that have a long life and are really in the value creation stage. But you'll see on slide 5 our IRRs on an annual basis. We did match the target IRR, the expected IRR in 2018 at 7.3%. This year, thus far, in just through 3 months, we're slightly behind the target at 7.3, which is 7.5%, but that's obviously very early. If you look at slide 7, here we show the attribution by asset class. So historically, we've shown this on a 1-year basis. Now, 1 year is a very short time frame, especially in the base portfolio. So because it's been a little bit more seasoned, we've moved this to a 3-year attribution. You can see the impact of each asset class within the portfolio, obviously significantly driven by both infrastructure and energy. About 93% of the return is coming out of those 2 portfolios. That's not just because they're strong or returning strategies, but also much bigger allocations. And about 40%, 80%, 40% in each, 80% total of your target allocation within this portfolio is to those 2 sectors. Timber and ag are a much smaller allocation. And you'll see there that the agriculture is still a slight detractor of total performance at negative 3.6% for the 3-year period. This is really also a result of both currency, limited value creation within this portfolio, but also some impact on performance. So the tariffs impacts, some of the farming impacts that you've seen in the news. So we are impacted by some of that, those factors. Timber slightly positive, similar factors there. There's also a lot of currencies in both of those portfolios. We have some Brazilian exposure that is impacting the U.S. dollar return there. The only other slide I did want to refer to, and maybe Peter, to your point earlier, this is a growing portfolio, is up on slide 12. So this is just quarter-to-quarter change in net asset value. So you'll see the increase there, a lot of contributions going up, very limited distributions, return of capital, and then there's some appreciation as well. But you'll see that this is a significantly growing portfolio. About $56 million was invested during the quarter, driving that increase in market value. So this portfolio is growing to that point earlier. Again, there's a lot of other materials in here, and happy to answer any questions about diversification or any specific investments.
Michael.
Yeah. Mr. Chairman, what kind of agricultural?
I don't know, Mr. Chair, I'm attacking.
Sorry, I was asking what kind of agricultural investments do you have?
Sorry.
And also, how much of
big due to this year because of what's going on?
Sure.
So our portfolio is, we've got what we call permanent crops, which are basically trees and nuts and things like that. That would include our oranges, our blueberries, hazelnuts, I think we've got some walnuts in there somewhere. And then we've got what we call row crops, which are the wheats and the barleys and the other kinds of seeds that are field crops that are rotated annually. The portfolio is global, so we have assets in across the U.S., but also in Australia and South America.
And then so the quarterly return on the portfolio is -1.5%. So that was the first quarter. So trying to picture where we were from January 1st to March 31st. That flows through. We have had pretty consistent negative quarters before that as well.
It's been a difficult time for the last 3 years or so, both in timber and ag.
And on that point, it's been an asset class we haven't committed additional capital to for quite some time. Slide 10 highlights the actual committed capital and the allocation by us, as you can see on there, that agriculture represents about 17% versus energy and infrastructure.
Anything else?
All right, any other questions? Thank you so much, Seth and Paul. We'll move to private equity and David Lee and now new name Mercer. Hard to keep up on the name changes.
Call me whatever you want.
As long
As
as you
long as I get to come back, that's all I ask for.
Here, look at you, you made a joke.
Oh,
You're coming right along.
yeah. Your influence.
Just gonna ask you to leave.
Wow,
Well,
Senator.
you know, I like it.
David, please.
As always, we have our first quarter report, as with real estate and real return. The performance is 1 quarter lag, so we'll be providing 2 reports for you. One is for the national program and one is for the New Mexico program. And we'll start with the national program. This is Alan Walder of Mercer. And I'll let him go through the whole report for you.
Great, thank you. And just so everyone knows, I still answer the phone incorrectly, so. Takes
But
you-
with which name?
It does take
How many
you.
generations of names? Back.
So I'll be fairly brief to some of the earlier comments and just try and focus you on the highlights. And I'm starting on our slide 4.
Diligent page 162.
Which has the summary, and I'll just call your attention to a few things here. I think just in terms of the split between active and liquidated, we added 8 funds to the liquidated category from active after doing a reconciliation with Indian. We determined that there were 8 funds that were liquidated. And so when you look at the numbers and the columns going from left to right, some of the highlights, total commitments are now, this is as of March 31st, 5.9 billion. You're over 6 billion now. And if you look at the net contributions and net distributions, you're almost even there. So you've almost received as much money back as you put into the program since inception, which is good. Performance has remained consistent. It's tough to move these long-term numbers over time, but they're good. We hope to inch them up in the 12 to 13% range. But when you look at the active, the dynamic you have to remember in private equity is that when you're adding significant new commitments, those carry a 0 to potentially negative return for some period of time. So you have that pressure pushing down, you have the mature funds increasing. So if you can keep it relatively flat while adding a lot of new commitments, that's actually a pretty good sign. If you flip to the next page, you'll see our sort of waterfall chart here. And a couple of things I just want to highlight. When you look at the change from 9/30 to 12/31, the net asset value of the portfolio declined. That was due to a number of factors. There was a lot of sale activity in Q4 before the late December volatility. If you remember, December 24th, I think it was, the market plummeted and was down significantly for the next few days. So you saw a lot of sales happen before that, and then you saw the valuation
change was relatively flat because of that downturn. And then if you roll forward to 12/31, you still saw a pretty significant number of contributions. Distributions started to pick up a bit, but were muted by that continued volatility. So any sale discussions that were happening sort of previous to the downturn effectively got delayed. So you had contributions significantly outweighing distributions, but you did have a big rebound in the values, as you can see in the net gain column. When you look at Q2, the split between contributions and distributions was much more even. So the contributions remained at about the same level, but distributions picked up significantly. Slide 6 just summarizes some of the specific fund names that had significant movements. And I'll skip to slide 7, which I think is an interesting summary here. So if you look at the performance going back to the year 2000, the portfolio outperformed the median net multiple benchmarks in all but 5 vintage years. And when you look at more recently, say in 2011 and beyond, while there's a mix of quartile rankings, the portfolio is generating double-digit or better net IRRs in each year since 2011, and we expect that to continue when we look at the underlying performance of those in 2017 and 2018. Those are still early, but off to a good start. And then the public market comparison, this has been a tough comparison for private equity for the last 10 years. If the public markets could continue to deliver, 12 to 16%, I think we'll all be happy. We would be fine with this outcome, but I think Vince and others probably think that's not going to continue, and we'll gradually start to see this table start to reshape itself. On slide 9, just a reminder on the strategy targets that these were approved, the latest version in the January 2018 structure study. There's been no real change to these except for the pacing, which is now at 300 to 400 million annually as the target. We updated that in May of this year. That's down from the 550 to 650 target that we had previously, and that was due to a number of factors, including the fact that we're getting close to the target. There's a lower plan return going forward, and so we wanted to make sure we were tapering down a bit so that we had ample capital to continue to deploy should the markets continue to flatten out and turn down. If you just look at sort of the strategy and geographic targets, all of them are within their range, and so we're happy with that. And then the concentration guidelines, we've got some other slides in the back that cover those. The rest of the slides go into detail about diversification and other things, and I'm happy to cover those or address any questions, and maybe I'll pause there to see if there's any specific questions. Okay. All right. We will roll into the regional program update. And again, we'll start on our slide 4, which
190.
190 in Diligent.
189.
So the quarter over quarter net asset value increased by about 7 million. I think just some of the highlights across the chart. The total committed is now over 534 million, with approximately 490 million of that having been invested. So if you're thinking about the statistics or sort of the dedication to New Mexico, it's quite a significant number. Distributions have come mainly from the fund investments. Just a reminder that the co-investment funds tend to have lumpy distributions. And you can see that if you look at the net distributed and net asset value columns. About 80% of the net asset value is concentrated in the co-investment funds. And that's really due to the fact that they generally have performed better than the other funds in the portfolio. So net asset value increases when performance increases. In terms of the commitment pacing, the commitments to co-investment funds have outpaced the commitments to the other commingled funds in more recent years. The co-investment funds tend to draw capital quicker. Funds tend to take a bit longer to deploy over time. Co-investment funds tend to deploy quicker and are lumpier. And the distributions from the NAV which you can see have been lower on the co-investment funds. And the portfolio is a little bit more concentrated because there's been longer hold periods and things like that. So it's a less diverse program, so it causes a little bit of lumpiness. But overall, when you look at the performance, it performed well to date. So we're pleased with that. If you flip to slide 5, there's a similar bridge as the prior is the national program portfolio. I think something to remember here is that in the regional program, the portfolio is less diversified. So you have fewer managers in the portfolio and fewer fund commitments, and therefore fewer underlying portfolio companies. So you tend to get a lumpiness in this portfolio that you don't see in the national program. Although some of the same issues are present in terms of the year-end market volatility causing some of the declines in the portfolio as of 12/31, only to see a pickup. But those effects are more muted because it's more concentrated and it's more local. So you have less of an impact, but you do see the same issues.
On the fund investments, on the previous page, it lists 22 funds, so it's a little bit deceptive. There's 22 active funds, but a lot of those funds are older and don't have a lot of value. So in terms of recent commitments, that number is much smaller.
And then flipping to slide 7, again, similar chart as the national program. You can see that the portfolios outperformed the median net multiple benchmarks in a number of years. When you look at the more recent years, say 2006 and later, the multiples are above the median, which is good. IRRs generally tend to be positive, whereas in the past it was a little more mixed. And there's also longer hold periods as a result of there's more commitments to co-investment funds. So if you look at the years 2007, 2013 and 14, a lot of that is capital committed to the co-investment funds, and you can see the performance there, but also that drives a bit of the concentration. Those 06 and 07 could be more volatile. So in the national program, and generally, if you have a fairly diversified portfolio, it's tough to move quartiles once you get past about year 4. So if you're in the second quartile, that tends to be where you'll end up. In a more concentrated portfolio, there's more chance for movement because you have a concentrated sort of position against the broader benchmark. So there could be some movement here. We hope it's to the positive as there's realizations and other things that come out of the portfolio. The last couple slides I'll hit are 8 and 9. I think the only thing I want to say in slide 8 is that a public market equivalent on a concentrated, regionally focused portfolio is not really applicable because it's not nearly as diversified as the national program or the public markets, and so it's very difficult to have that as a target to beat. So I wouldn't put too much weight in that. And then looking at slide 9, really this I think is a good summary to sort of try and focus on. The program, to remind everybody, really takes 3 approaches. You've got the Catalyst Fund, the co-investment funds, and then fund investments. And so as you can see, the NAV is higher on the co-investment funds when you look at the concentration for the reasons I mentioned. And then if you look at the 2 pie charts below, really by commitment, it's fairly evenly balanced between fund investments and the co-investment funds. But when you look at the exposure, it's more concentrated. And just as a reminder, exposure is net asset value plus unfunded commitments. So it's heavily weighted to what's been called.
And this slide is a little bit different than the one in the national program. The national program tends to list by strategy. The reason why we didn't necessarily keep it consistent for the New Mexico program is because this is a predominantly venture capital program, so it wouldn't make a lot of sense to show 90-something% in venture capital. So we think this is a better way of looking at it. To the extent that we can expand the program and add different strategies, then it would make more sense eventually to move to the format of the national program.
And a couple slides that I don't think have been in our recent decks are slides 14 and 15, which really hit on the economic impact update. So these lay out a number of different statistics to really try and quantify the impact. of the New Mexico private equity program. Just a few notes on these. We used documentation from Sun Mountain and from Invient to cross-reference some of the numbers. Invient doesn't have every company going back to inception, so this, there would be some changes if you were to get every single data point going back as far as the program started. But this is the best set we could work with. When you look at some of the key statistics, new companies funded over the last 12 months, the program continues to be active, which is great. We have two rows here, the invested capital in New Mexico-based companies. One is at the SIC level and one is at the fund level. The SIC level really reflects your portion of the fund you're in. So if you're 10% of a $100 million fund, it reflects sort of that 10 million, whereas the row below is the total fund, so it reflects the impact of the total fund. Then we've got some other statistics throughout here that help summarize some of the impact. So those were the slides I wanted to hit. Happy to take any questions or comments.
Lee, did you, I'm sorry. Stephanie.
Yeah, David, on slide 7, when you have the vintage years of the different funds, why are we missing like 11 through or 9 through 12?
There was, so in statute, there is a cap.
So everything was invested, so we started?
Yeah. It's based on the denominators of sentence tax fund. And at the time, we were kind of tapped out. It's definitely not a great thing. We prefer, that's why we go to the trouble of using pacing models to try to establish a consistent pacing from year to year so that we're vintage year diversified. This was a particular situation where we had hit a statutory cap and we had to stop until sentence tax had grown.
Yeah, sorry, I should have clarified that. If there's not a year there was no commitments made there.
Thank you. David or Alan, back on page 6, I'm just looking at the quarterly contributions and the quarterly distributions, and we have, of course, tranche 17 being both in the contributions and the distributions. I'm assuming that was a capital call for $500,000, right, to cover management expenses or fund expenses. But what was the distribution? And I mean, they kind of offset each other pretty much.
You know what, I don't remember the one January offhand. All the monthly reports by transaction are usually behind these, but since I was trying to catch up, I have the last 2 or 3 months. I can definitely go back to February to check that out for you. But I believe the February capital call was actually a capital call. This was a capital call for investment as opposed to management fees. But I can get you that information.
If you could later, it's good. Thank you.
Yes, Mike.
David, that problem with the cap, does that suggest that there should be some consideration to increasing the cap? Is that a long-term problem?
I think there's people that are working on and debating that particular topic. It is something that we do have to take into consideration. We have to assume until it's changed that it's going to be in place. And I think the most prudent thing to do in that situation is to try to balance your pacing so that you're not getting right up to it. Yeah, because you're trying to leave room for appreciation. You're hopefully going to bring that down with distribution.
This is the same.
But the timing of those can be very uncertain. Okay.
That's it? Any other questions or comments?
And for anybody that loves detail, behind the national program and behind the New Mexico program reports are listed of every fund and their reports. So if you care about individual.
They do. Thank you, David. Thank you, Alan.
Thank you.
I apologize for being late. I'm going to take over the meeting. I know that we introduced, but I want to personally welcome our team members, new members, Michael Messina and Tracy Hartzler, and I see that you're incredibly engaged. And also, if Tim Jennings, if the senator is bothering you, Tracy, I can have you moved on that. I did notice that was occurring when I walked in. You're all right?
Nothing but a quick tap is fine, so.
All right, well, good morning, everyone. I apologize. I was at an event this morning talking about rural behavioral health. But I appreciate that everyone was here so we can go on and we can move forward. So we are
I thought you were
now,
talking about Jennings.
huh?
I thought you were talking about Jennings.
When I talk about rural behavioral health,
Yeah.
I don't know what that means, so I'm not going to take that one off.
We can take about, talk about behavior in cabinet meetings and stuff like that in the past.
Well, the meeting's gotten off track, so we're definitely now on item 3. This is what's both wrong with and wonderful about state that's this small. Thank you, Senator. All right, we're on 3. These are matters requiring a vote and action. We're going to have the investment committee report. I'm going to go to Linda.
It was one of our easier meetings in some ways because both the managers and the consultant that were the matters on the meeting were people who we were familiar with. There were 3 voting items, all of which were approved unanimously. The first was the Clarion Partners. That is a manager who we are familiar with, although this is a new series with that manager. The other was just an addition to the existing tranche for Sun Mountain, of course, a manager who we're very familiar with. And the third was renewal of the contract with our consultant RBK, which of course we're very familiar with also. And again, all were approved unanimously by the investment committee with all members present.
Terrific. All right, let's have a report by Clarion Partners now.
Well, good morning. So we recently received a distribution from the tax stabilization reserve, and because 20% of the tax stabilization reserve goes into the real estate bucket, that gave us about $120 million, $125 million to invest in a core manager. And just to give a little context for the new members, we invest in open-end funds, which are sort of, they're semi-tradable. We can get liquidity. It sometimes takes a while to get out of them. Those tend to be our very conservative strategies, like this one. We also invest in closed-end funds. Those are the ones that we send them the money, and they give it back to us when they're done with it, basically. We don't have a lot of control over what happens in between. This is not one of those. Those tend to be the higher risk strategies, what we call value-added or opportunistic. So this is a core strategy that we're recommending today. It's a $125 million commitment to the Clarion Line Properties Fund. This is a $13.1 billion open-ended real estate fund. It is one of the Odyssey funds. Odyssey is the benchmark that we use for measuring our performance. They are one of 36 funds that makes up the Odyssey index. Once this is funded, and with the recent commitment we made to the PRESA, that was a $300 million PRESA core fund from the rebalancing that was mentioned earlier, by my rough math, we get up to about 11.2% allocated to real estate against our 12% target. And we have a pacing plan to get us up to 12%. The one thing that this does is it throws us a little bit out of whack. We end up now with about 68% core, 32% non-core against a goal of 55% core, 45% non-core. So again, we have a plan in place. This money kind of arrived in front of us. We want to get it deployed as quickly as we could, but we have a plan through making new opportunistic and value-added commitments, closed-end funds, that will balance out over the next 3 years back to the sort of the 55-45 split. We just again to give a little background on the real estate market, there's like 4 sectors generally that, well, 5 that we invest in: office, retail, industrial, apartment. And then there's an other bucket, which is storage and senior housing and medical office and things like that. They tend to be much smaller sectors, so we just lump them in as other. There is one sector that is very out of favor right now, and that's retail. And as anyone who's read the headlines would know, Retail bankruptcies are happening almost on a daily basis. There's store closings. As you walk through your local mall, you'll see that there's not as many tenants there as used to be. So we are doing what we can to avoid and reduce or avoid taking on additional retail exposure. Every core fund has retail exposure, so we can't avoid it altogether. So that's one sector that we've got, an asterisk. The beneficiary of that decrease in activity in the retail sector is the industrial sector, because everything is being purchased now as retail sales grow, which they are absolutely. That activity is being routed through industrial facilities, warehouses. And so the industrial sector is an area that we want to grow our portfolio and be above benchmark. So that's two of the things that we were looking for when we identified a manager, a home for this new capital, this $125 million from the tax stabilization reserve. So we did our diligence on several managers, and we met with Clarion, an existing manager. Clarion is a highly respected firm. They have about $50 billion of assets under management. We are in their Lion Property Fund, Lion Industrial Fund. Lion is has been one of our strongest performers. We've got $230 million in that fund. Their net returns over the last 1, 3, and 5-year timeframes are 18.4, 14.7, and 14.8%. So these, in the real estate context, those are really, I think those are our strongest returns that we have in the portfolio. So we like the management firm, we like the team, we like their ability to source deals. We like the composition of their portfolio. They're also underweight to office, which is another sector that we get nervous about, especially as we get deeper into this economic cycle. And they're overweight or trying to be overweight in multifamily. So with that, and the other thing about them is there's no queue to get in. So we're going to write the check. They close us monthly, so we'll write the check for $125 million once we close on the documents, and the money will get to work immediately. So.
Sure, Paul said, give you a good introduction and a good description of portfolio construction. I'll maybe make one or two quick comments. So Clarion, has been stated here, is an existing manager within the real estate portfolio. Today, that Clarion Lion Industrial Fund represents approximately 7% of the real estate portfolio. This additional commitment will take our Clarion exposure up to 10% on a standalone basis. That number will adjust as other capital is called and returned and funded, but that is well within our policy limit of 30% to a single manager. So it will not be our highest allocation, will not be our lowest allocation, right there in the middle. As stated in Paul's comments, the Lion Property Fund is a $13 billion fund, diversified across sectors, across regions. The fund began investing in June of 2000 and has consistently outperformed over the past 10 years, really coinciding with both the change in portfolio construction, but also the change in portfolio management. One of the two co-portfolio managers here is here today, and you'll hear from John Gelb. And lastly, the Lion Property Fund does focus on a strong income return with really the potential for long-term growth. So we're focused on income today, given where we are in the cycle, but also core real estate really is the baby in the portfolio. Real estate, the attributes of real estate is collecting rents, collecting that income and distributing it back to you all. So that's where this fund fits within the portfolio. The fund will put an emphasis on recently constructed assets or assets located in the more desirable locations. So Tim, to your question earlier about multifamily, the multifamily that they will look to own is the newly constructed, more amenitized, smaller boxes, but higher quality multifamily that is more in favor today. And then also with to Paul's point, higher exposure to both industrial and under exposure or under allocation to retail. Going forward, we do project the fund to continue to outperform the Odyssey Index, your benchmark. This fund has been approved by Townsend's Investment Committee on a standalone basis and also within the context of the SIC portfolio. So with that said, I'll hand it over to John Gelb, the co-portfolio manager, and John.
Thank you, Seth. Thank you, Paul, and thank you all for inviting us in here today to present the Lion Properties Fund. I'm Joanne Vitale of the client service team at Clarion, and I'm joined by John Gelb, who's portfolio manager for Lion Property Fund. I'm going to make just a few brief remarks on the firm and then turn it over to John to provide just a few highlights on the fund. But for starters, Clarion is one of the larger, more established real estate investment managers in the industry. We have $50 billion in assets under management in the US and Europe, and we have a 37-year investment track record. So highly experienced investment team, investment discipline. We are an independent affiliate of Legg Mason, which is a global asset management firm. And our ownership structure is a distinction for us in that our senior investment professionals at the firm own an 18% stake in our company, thereby providing strong alignment of interest with our investors. In terms of our platform, in the U.S., where the Lion Properties Fund is focused, we are national in scope. We're headquartered in New York, but we've got 5 regional offices throughout the country located in strategic markets. As well, we have substantial resources in these markets in key investment areas, in the investment research area, in acquisitions, and in asset management, which together combine to contribute to the execution and are integral to the execution of the Lion Properties Fund. Just a couple of words on the fund. Paul and Seth covered a bunch, but Clarion is, Lion Properties Fund is Clarion's flagship vehicle in the core Odyssey space. We now manage $13.5 billion in assets on behalf of 350 investors globally, many of whom are large public pension funds like yourselves. The strategy that John and the LPF team put in place has led to significant outperformance of the Odyssey benchmark over the past 10 years, and we believe that the fund is positioned for continued growth as we look to the future. So those are just some very brief remarks on the firm, and I can entertain questions now.
Just a comment,
Yes.
we actually are not a pension fund, but a sovereign wealth.
A sovereign wealth, oh, my apologies.
Major significant difference in
Oh,
company
yeah.
liabilities.
My apologies.
No liabilities, life is good.
Could be better, Peter.
Could be better.
Okay, all right, thank you for making that
Thank you for that,
clarification.
thank you for that
Certainly.
clarification.
John,
My
do you want to
apologies.
add anything to this presentation before we entertain questions?
A couple of very brief remarks. First of all, thank you all for having us. Very nice to be with you. This morning, the group has already talked a little bit about the fund. I think if asked our investors, we have a strong and deep group of investors in this fund. I think if asked, they would say we excel in a couple of key areas. We're very focused on portfolio construction and strategy. We think long and hard about which are the best markets and sectors to invest in. We spend a lot of time with our research group, with our boots on the ground in thinking of that and setting that strategy. And second, I think our investors would say we excel at active, hands-on management. That's obviously critical in real estate. It's an operating business. We work really hard once we acquire assets to add value by renovating properties, by working the rent roll, working with our tenants to raise rents over time. We do have a number of strong elements in the fund today that helped our performance. As has been noted earlier, we are overweight to the industrial sector. That has been the best performing sector in U.S. real estate. We expect that to continue. We are underweight to the retail sector, which has had the most headwinds of any sector in U.S. real estate. And importantly, we own no malls, which have been probably the part of the retail spectrum that's faced the most headwinds to date. We are underweight office, which is historically a volatile sector, but we do own a very strong office portfolio that's borne out by our historical track record in that sector, where we've outperformed our benchmark in office in recent time periods. And last, we own some healthcare properties. We own what we call lab office, which are specialized office buildings designed for pharma and R&D companies to do drug development. We see a lot of strength in that healthcare R&D space in our market. So all of that strategy, which again we think is positioned us for growth, but we also think has positioned us somewhat defensively, given we're underweight retail and underweight office, and overweight to industrial, and overweight apartments, which we think are the two lower volatility, higher growth sectors. All of that has resulted in strong performance. So we've consistently outperformed our benchmark over the trailing 1, 3, 5, 7, and 10-year time periods. With that, why don't I pause and open up for Q&A wherever you'd like to take it.
Terrific, thank you for your presentation. Do we have questions from members? How about that? All right, so Member Eidson, do we have, oh wait, I spoke too soon. Yes, Member Frank.
Just a quick question. So we have a management fee, but no performance fee, is that?
That's correct. There's only an asset management fee in this fund. There are no performance
Is that this
fees.
fund or all your funds that are structured this way?
That's just this fund, given its core profile. Other funds have different fee structures.
But it's very typical of all our core funds. We've got some core funds that invest a little further on the risk spectrum that may have an incentive fee.
Thank you, Member Frank. All right, I think we go back to Member Eidson. Do you have a motion?
Yes. All right. Based on the recommendation of the Council Investment Committee, Real Return Advisor, the Townsend Group, and SIC staff, I move that the SIC approve a commitment of up to $125 million to Clarion Partners Lion Property Fund, subject to and contingent upon New Mexico state law, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, any discussion on the motion? Thank you for the second. Seeing none, all those in favor, say aye.
Aye.
Any opposed? Any abstain? Motion carries. Thank you very much. Congratulations.
Thank you.
All right, we are now on item 3C. It's the New Mexico Private Equity, the 2017 tranche additional commitment. And is there a change? We're going to have Vince present this. All right.
Thank you, Governor.
You're welcome.
Before I spool up on this one, I want to correct a number that I gave Member Rawson on our earnings and cash. If you'll flip to page 65 of your materials and scroll down toward the bottom of the page, you'll see a line item that says cash equivalent deposit. That was the cash that was at the time in the fund. And if you move across to the 1 year column, you'll see 266. That was the earnings on that cash for the year. I think I was living in the past. How could you do that? Yeah, I think I was living in the past. I was giving numbers that look more like 3 year. More in the future, it looks like the Fed's going to cut interest rates and that number's going to go down. But I want to make that correction.
Great, with that correction. All right, thank you, Senator. Questions?
Excuse me. Okay, so on page 325 of your book, no, I'm sorry, that's not right. Yeah,
It is. 325.
okay, yeah, that's Mercer's memo. Okay, so we've got a memo from Mercer there on 325. There should be one behind that for me on, from the staff on 326. Recommending a $5 million top up to the 2017 tranche for Sun Mountain Capital. We've got an extensive discussion there in the memo. We won't run over that for you again unless you want to talk about it some. But Sun Mountain and staff started discussing potential new tranche for this program. This is our co-invest program. But we had just brought Mercer on board, and Mercer and Dave and Chris are working on a structure study to bring to you in November. And so we didn't really want to pull the trigger on a new tranche for this fund, pending what they're going to find in terms of the structure study. So in talking with Sun Mountain, it looked like from what was still in the fund to be drawn, or what was still committed to be drawn, an additional $5 million would get them through the end of this calendar year in terms of ongoing investments in current companies and new investments to be made until the end of the year. So we're recommending the $5 million. That'll get them through the end of the year. We'll be in front of you in November with a structure study and some recommendations for the program at that time, and we can go forward.
All right, do we have any questions about that report and that strategy? None? Any comments? All right, Member Eidson, we are ready for a motion.
Based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and general fiduciary oversight of RBK. I move that the State Investment Council approve an additional commitment of $5 million from the New Mexico Private Equity Program to tranche 2017 of the New Mexico Co-Investment Fund LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
We have a second. It was kind of a quiet, which is not like you. Yeah, oh,
Sorry, got a little bit choked up on that one. Second.
yes, sir. Now I heard you loud and clear. Do we have any questions, comments, concerns on the motion? All right. Seeing none, all those in favor say aye.
Aye.
Any opposed? Any abstain? Motion carries. We have the authority for $5 million. All right, we are now on 3D. It's the RBK contract renewal. We're back to you, Mr. Smith.
Good, talk about RBK.
All right. Well, there's a memo in there from the, that's on page 326, RBK. This assignment for RBK is, in my view, more difficult than most of the others they had. They report that back to me. They tell me they love working on account, but it's hard. A couple different reasons. One is our sovereign wealth nature makes us different than pensions.
Can I get everyone's attention on this report?
And most of their clients are pensions. Now, they do have some sovereign wealth, and CS is the consultant on most of the sovereign wealth accounts that they have, at least out here in the West. The second reason is our investment process is top-down in nature, so we develop a view of the economy and markets, and you heard some points of that this morning.
The system has detected that your line is the only one in conference and will attempt to close this conference. If you wish to remain in conference, please press the key now.
Thanks, Peter. Who's in charge here?
I'm sorry.
Jeez, let's close it.
Right decision.
I like when we're unified.
Right.
Did I scare the treasurer away with that 266?
I don't think we ever joined the
Proceed.
So anyway, our top-down nature of our investment process, where we develop a view of the economy and markets and develop broad strategies and our asset allocation, puts a particular pressure on the asset class directors and the consultants that support them in building those portfolios in order to balance what they're seeing in the markets and what we want on a longer-term sort of strategic basis. So it requires work that they don't do for very many other clients. And so they've got a tough job, so do those 4 asset class directors sitting around this room right now within our investment process. RBK has done a very good job for us since 2011 when we first hired them. Part of the things, or a number of things they need to do are source and diligence managers, support the asset class directors in developing those asset class portfolios, and then help me with asset allocation recommendations and so forth for you all, in addition to what other consultants do, and that's at the policy level, developing the investment policy. So there's an additional layer of work that they go through due to the process that we have. Now, it's worth it to us. We reviewed the performance numbers earlier today. It comes through in the numbers, and they've really held their own and held their position as general consultant for us since 2011. So we're recommending that you retain them for an additional 4 years, and we'll do another review for you if you accept that at that time.
All right. Yes, Madam Commissioner.
Thank you, Madam Chair, Madam Governor, great to see you.
Same.
So you said they've been with us 12 years?
Since 2011, June of 2011.
And so how frequently do we renew the contract?
We renewed in 2014, and then there was we tried to renew in 2014, but we did a 6-month extension. I brought the contract to the council only a few weeks before it was expired, and the council wanted another month to think about it. So we did a 6-month extension, and then we did another 4 years past that. That puts them done in October.
And the fee is just that straight across fee?
There's a flat fee, and it escalates at roughly the rate of inflation each year.
And are they participating in this structure study for the New Mexico program?
No, that's Mercer.
Yep. Okay.
All right. Any other questions? Yes, Senator Wilson.
Yes. Vince, we've got on here on your memo that the new value is 501,000, but it doesn't say what that was prior. So we've got the new fee and we have the escalation. I didn't see the current.
I could offer you, to show you each year what we paid.
Well, I'm just wondering what the 501.4 is in relationship to what it is currently.
I'm not sure.
Am I not where you want?
I'm
Okay,
not
what's
sure.
the,
Yeah, I think John can find it.
$482,000.
thank you.
Any other questions? Senator?
I just think we should probably note that they've left above. The RBK people left under our conversation.
Yeah, thank you very much, Senator. I should have mentioned that. I appreciate that reminder so that we are clear for folks who are watching where we are and that we're having a conversation without those individuals who are affected by this decision present in the room so that we can have a earnest and transparent conversation about strengths and weaknesses. Thank you, Senator.
Yeah, but they're listening.
They're not here, so we do our very best. It's an interesting dynamic. Anything else about that, Senator?
No, ma'am, I just want to say I thought it was nice that they did.
Yeah, I agree. It's an appropriate sort of professional aspect, even though, yes, we can all listen. I can listen while I'm in the meeting. Sounds like how the Democratic caucus in Congress works. Yes?
No, I'm sorry, I didn't,
You're good?
I'm good.
All right,
I think,
Mr. Lerner,
that's
you're all
great.
right, number one. Anybody else?
Let's hope it works.
All right.
So,
We want to invite them back in for the motion. We want to just keep it out. All right, just checking in. Member Eichel, would you like to make a motion?
Based upon the recommendation of the Council Investment Committee and SIC staff, I move that the SIC approve a 4-year contract renewal with RBK, Inc. to serve as the SIC's General Investment Consultant under terms and conditions detailed in today's meeting materials and is reviewed and discussed today by the Council.
second.
We have a second by Senator Jennings. Do we have any discussion about the motion? Seeing none, all those in favor signify by saying aye.
Aye.
Any opposed? Any abstain? The motion carries.
A cake?
I didn't bring it in.
Now, all right. We are now on number 4 on the agenda, finance matters and informational reports discussion. First is the audit committee report. Member Frank, you are up.
Thank you very much. We did meet yesterday for a fairly extensive meeting, important meeting. We had our entrance conference with Moss Adams, who are the auditors, and they will complete the audit of the fiscal year just ended in June. And that will be done in November. We'll review that with them. And a lot of extensive discussion with them on the emphasis of the risks that we see, areas of special attention that we would like them to emphasize in their work. This is their second year, I think. Yes. They were brought on last year, and they seem to be doing a very effective job for us. They completed their interim work, and at the moment, although it's preliminary, we don't have any significant findings coming out of that work, which is good. We also reviewed with Brent his draft appropriation for next year, which is the fiscal year 21, I guess, which starts a year from
July 1st.
Yeah, July 1st of next year. So we're always a year ahead in terms of financial planning. So this goes to DFA, and Olivia's team will work on that for us in the next few months. We did approve that recommendation to the council here. It's in the materials. I don't guess we approve it, the council should approve this appropriation request. And so we'll make that motion shortly.
Yes.
I don't see it on the motion list, but we can, I don't see it. It's not on the agenda that way,
Oh,
that's
okay.
fine.
All right. And then we also, of course, as is typical, we review the budgets and financial reports for the current period. And we discussed as well our work with Colmore, which is a consulting firm that we brought in several months ago to help us review in detail the private equity and private investment reporting to us and the accuracy with which they are assessing us fees and costs, and that is a very, turned out to be a very useful process. And they, we find, are actually extending their reach to a lot of investment funds around the country, so they are becoming a much more important factor in the industry. And I think that's all, so I guess I will make the motion.
Well, let's ask if anybody has any questions or comments before we go to the motion. Does anybody have anything? Yes, Member Hartsworth.
Let me ask the question about the budget. I think Steve had mentioned earlier that he's requesting an increase for compensation for individuals of staff. And does this FY21 budget include those increases that you were proposing?
It would.
Thank you.
And I have just a few comments too.
Yeah, sure.
Let's, Senator Lawson.
Yeah, that's really where I wanted to go, so thank you. As we look at that line item, 520300, what I heard Steve say in his comments earlier was an increase of 81,000 or 8.2%. But this looks like it's a different number than what Steve's saying, or what I thought I heard. Maybe there's other things implied in here. But this looks like a 10.5% increase, no increase in FTE. Maybe less vacancy factor, but I'm just trying to bring your numbers here versus Steve's statement earlier.
Sure. And I think Steve was talking about, I think seven different employees for his comments. This is for the overall appropriation request as it relates to fiscal year 21. So those increased amounts currently that we talked about will absorb them in the current budget. Going forward, you're seeing an increase because and I think you touched upon it, the vacancy factor. We're hoping to fill some positions, at least 2 positions that we don't have filled and don't have appropriated at this point in time. And we've subsequently asked for that in this request.
Okay, so we're asking for 33 FTE, or we're at 29 and we want to get to 31?
Yes, 29 and we want to get to 31.
Then the other question that I have towards the end of that page is 543830 with just the IT agreement and stuff. It looks like maybe GSD or ID. We're trying to up the rate. It's kind of an incidental amount, but I just.
Sorry, where's it at?
The second from the bottom one. It just looked like a pretty substantial percentage increase, and I just kind of wondered what they were doing.
What's the line number?
543830. It's the second one from the bottom on page 367. It's
yes.
not a big dollar amount, but it's just an interesting standout. It was 5,000, they jumped it to 10, it looks like it was 0.
Yeah,
So
they're doing some kind of retooling on some of the fees that they're charging us. And to give us a little bit of cushion going forward, we try to work in what we anticipate. They're doing some things differently with Outlook and other licenses that we have. So I tried to work that into the budget.
Because I knew there was a year or two there where there was a considerable cost shifting, particularly with liability and some other things. And so, but you're just hedging ahead. There's nothing there. Because even the IT support ratcheted way up a while. So, okay. Thank you.
Yes, Member Stephanie Garcia Richards.
Thank you, Madam Chair. So what's the percent increase?
That's a good question. I didn't get to make my comments, but I will. Now, if you go to actually, this is kind of good news. If you go to page 369 and look at the very bottom of that request, you can see for fiscal year 21, the request is $58.4 million. That's in comparison to the prior year, the fiscal year ran 61.3. So we actually have a decline year over year. And the majority of that decline is being driven by reduced investment assumptions as far as returns are concerned, which drive some of the fees. You have to remember, within the appropriation request, there's basically three categories: the 200s, the 300s, and the 400s. The 300s is the middle category. That's where the investment management fees are. Investment management fees and consultants, RBK, Mercer, et cetera, drive about 9% of the budget. So as we make reduced investment return assumptions, our appropriation request does accordingly go down.
And Madam Chair, I think that's on your next page with your fee projector.
Yes. I'm glad you touched upon
Yeah,
that.
I'm sorry.
This fee projector is something that we've done. I think this is probably the 6th or the 7th year that we've done it. One of the real challenges in what I do for the appropriation is trying to forecast where we think we're going to be at the end of fiscal year 21. That's a full 22 months out from where we're at right now. First thing I do is say fiscal year 19, here's where we end. Where do we think we're going to end fiscal year 20? Talk to Vince. We worked in about a 5% assumption on that. And then for fiscal year 21, he actually provided me some return assumptions for the stock and the bond market, as well as standard deviations. And if you've ever taken a stat class and you think about a normal distribution, you have the kind of the mean in the middle. We kind of start there and adjust it by 2 standard deviations from the mean, and it provides us comfort that I can say, based upon these forecasts that I did within the fee estimator, that I'm 95% certain that we will have enough budget to get through this fiscal year. I could probably ratchet that assumption down, make the request less, but I'm trying to make sure that we have enough. Not enough is a problem, you know, given that we have over 30 mandates that we pay management fees on. But I'm happy that this fee tester estimator that we've used, we've I think worked out some of the kinks in it, and it's worked very well with us. We've never been to a situation where we've been caught short as far as the budget is concerned, and I think that's kind of proof that it's working pretty well. But
and Madam Chair, if you are short, can you do a bar? Or?
Yeah, you can, and we can certainly. I mean, if we
Does
wanted
everybody know
to.
what a bar is, a budget adjustment? Okay.
Yeah, we could go leaner. The problem is the bars always come kind of at the wrong time. And one of the things that I should also point out, and I think especially for our new members, and I think they know this, we are kind of self-funded from the land grant, the severance tax. So any excess budget that we have in any one fiscal year, we just revert right back in conjunction with the completion of the audit.
Any other questions or comments? Thank you, Madam Land Commissioner. Okay, all right, so then Member Frank, we're to you for a motion unless there's any following closing remarks. Okay?
Based on the recommendations of the SIC Audit Committee, I move that the State Investment Council approve the preliminary fiscal year 2021 appropriation request of the SIC as presented and memorialized to the council.
Second. We have 2 competing seconds, so just because we don't want Harold to be on the only one, I'm going to go to Member Eitzen. But thank you very much for being ready to go. Mr. Lavender. Are there any questions or comments? You helped him on that one?
Yes, Madam Chair, I think that Brent deserves some kind of acknowledgement for turning in a negative increase budget.
Thank you. You have to realize what's driving it.
That is actually very, very bad news. They do not want to make
We do not want to.
No, we do not want to make a budget. The reason is that our budget is 90% or X% driven by the fees that we pay on performance of our investments. The higher our performance, the higher our fees. When the performance is not quite at the level we expect, our fees go down. That indicates.
However, we
not
do
what we
want to
want.
be able to, for the record, I will actually disagree in this regard as a clarification. With the challenges about overpaying fees, the opportunity to identify what we're paying, why we're paying it, and how well we're doing needs to be balanced in our comments and in the description of the budget request and then the overall appropriation. So I actually agree with the commissioner that that's effective, although these guys are a handful already. Giving them any more accolades is more than I can deal with already. So I don't know that I'll go that far. Yes, Member Ross.
I was just gonna say, I thought it was because they didn't think they were gonna get enough contributions from the land commissioner.
Oh, it's going downhill again. I can see it already.
Deteriorating.
It's deteriorating. Any other comments or questions, concerns? All right, seeing none. All those in favor of the motion, say aye. Aye. Any opposed? Any abstained? Budget's approved. Motion carries. Thank you, Mr. Frank. All right, we are now on, Brent, you're back up. We are on the CFO report in general.
Sure. Behind, I guess it's on page 330, is the budget for the first month of July of the new fiscal year. And I just want to point out, I think it's somewhat apparent, but when we go through and do a budget, you have not only actual amounts, you have forecast in here. Given that this is the first month of the new fiscal year, we have 1 month of actual and 11 months of forecast. So as we get into the fiscal year further and further, the actuals will be more dominant compared to the forecast. So just keep that in mind. In July, this is probably one of the roughest months for forecasting because it's the majority of what's in the report. And then I also wanted to point out, if you go to the investment holdings report, and I think I'm on page 336. 336 is the total assets page. You can see at the end of July, we're at $26.2 billion. If you go forward to page 341, you can see the new tax stabilization reserve fund. This is a new fund that started July 1st. And then if you go one page from that forward, you'll see the Rural Libraries Endowment Fund. These are both new funds that we haven't had on the investment holdings report before, and that's the reason I point those out. And then I also like to point out on page 343, you can actually see the third-party investors. Those investments total $1.84 million at the end of July. And, or I'm sorry, $1.1 billion. I stand corrected. And then also want to go to the note page, which is on page 365. If I could. These are kind of the highlights. I think some of them we've gone over already, but I do want to point out on that first bullet. Steve mentioned the $90 million from the land office in July. I think, maybe Charlie wants to correct me, but I think that's an all-time high. I don't think we've ever had inflow from the land office in any 1 month that has exceeded that $90 million. So thank you for that. And then also I wanted to point out on the second bullet, the distribution to beneficiaries and to the severance tax permanent fund. Those are recast at the beginning of the new fiscal year. These are the new amounts that are going out. So we kind of pointed out in the past how those continue to increase year over year. And then I also noted here that the inflow from the tax stabilization reserve fund coming in was $526 million. And there's underlying schedules. You can actually see what activity, the 526 million came in, it was invested, and you can see some related earnings on that. And then lastly, I wanted to point out, because I think it's kind of an important point if you compare this next to last bullet regarding the SBIC. If you look at prior months and compare it to the valuation that's actually carried now, they've gone to GASB reporting. Before that, they did something other than GASB as a result of some of the new requirements that they have and the fact that they're into economic development. They have to carry some of their investments at closer to cost. So there was probably about $4 to $5 million markdown relative to prior periods, but that's only because they changed the way that they're reporting things. And that's all I have.
All right, do we have any questions or comments about the CFO report? All right, thank you very much. We've already done the vote about the appropriation, so we are now on item 5, which is closing matters. Old or new business, I have none for this particular item. Any other members have any issues they wish to address, old or new? Yes, Senator?
I'd just like to point out that most of the oil field stuff, it shows that they're drilling and their activity is down about 14%. And they are doing more things more efficiently, but there is a cooling off period that, to me, seems to be happening. The drilling activity, it doesn't seem to be as quite as robust as it was. And I don't know, some of the reports that we get about the area that we have. I mean, there's a lot going on, but the price of oil, between the price of oil and I don't know that if you can say it's the tariffs, you can't put tariffs out there without tweets. I'm not sure that tweets don't cause more problems than tariffs, but it just seems like it's getting a little bit, it's not as robust as it was, but it's very busy. I mean, it's busier now, but it's just not as...
Without having the specifics, there are the indication by the New Mexico Oil and Gas Association and by the Permian Partnership and others that they have in their own projections and in efficiency efforts have made 10-year plus commitments that are working to stabilize. What that will actually translate to, given that it's a volatile market under the best of economic circumstances in terms of we can get our arms around what the stability looks like. Numbers may not be what we would anticipate or desire, but we are in an unstable world economic view. I think we're in an unstable U.S. economic view. There's no predictability about where we are and where we aren't. Hard to say. I think we've had lots of conversations with the new members about what markets might look like, what folks are talking about in terms of recession indicators, and what we do in our own effort about volatile markets that really are the bread and butter of the revenues that we have available for investments. And I do think that it's warranted to have those comments made and be on public record so that folks know that we're paying attention to the degree that you can't. We can always pay attention how our projection models look in this climate, tougher, but I appreciate the recognition that that's an area we need to keep paying attention to, and we do. Am I missing anything? Yes?
Actually, yeah, I just kind of want to piggyback on that, and I will be in attendance at the LFC hearing tomorrow because I'm real curious, not only on the consensus revenue estimate, but also just what the economists are saying about this very thing. What we're seeing in our numbers is that in the past, you'd seen the WTI sort of have fluctuating impact on production, but production is just really through the roof, sort of irrespective of what WTI is like. So it's going to be interesting to hear what they have to say tomorrow, and I don't know if this council wants to get a report sort of on the forecast of the industry. But
you know, if the big pipelines get through to the Gulf, you know, I don't know whether we're going to keep getting a bump for being West Texas crude as opposed to Brent crude, you know, just because we're just going to be exporting so much approved, it is a better product. But those pipelines are getting closer and closer to being done.
Okay, thank you both, and I know that they'll get the LFC projections and reports, and so will my office, and I'm thrilled that you will be there. And I know Olivia is already participating in that effort, so it's a good group. Seeing no other discussion on old or new business, we want to make sure that at item 5E, the next State Investment Council meeting is Tuesday, September 24th at 9 a.m., same place, basically same time. And we are now on item number 6, which is our public comment period. Do we have anyone here for public comment today? All right, seeing none, I would take a motion to adjourn.
So moved.
So moved, and we've got the motion by Member Lavender, the second by Member Senator Jennings. Any discussion, comments? All those in favor say aye. Aye. Anyone opposed? Nobody abstained. We are adjourned. Thank you all very much. Apologize again for being here.
You got it.
Nice to see you, Olivia.